This is the World Financial Report podcast. My name is Randy Marshall. Joining us is our financial and diamond expert, Harold Siegel. We're taping on March 15th, 2018. Our time is 8:15 in the morning Mountain Time. Harold's website is rarecoloreddiamonds.com. rarecoloreddiamonds.com. Connect with Harold at 1-800-432-1022, 1-800-432-1022. Market update for you, as we usually do to start the program. Of course, Saturday, St. Patrick's Day. Happy St. Patrick's Day. Next Tuesday is the first day of spring. March 30th is Good Friday. U.S. dollar at 89.90. Canadian dollar, it's really slipping again. 76.78. Gold, 13.80. Silver, 16.40. Gold silver ratio 80. Platinum, 9.59. Palladium, 9.89. WTI, 61.18. Brent, 65.04. Nat gas, 2.74. Bitcoin in U.S. dollars, 82.2486. Bitcoin in Canadian, 10,710.09. And starting the day off on the stock markets, the Dow at about 24,767, S&P 2,753, NASDAQ 7,474, and TSX 15,692. Interesting to note as we start the program today that in the United States, another retailer has bit the dust. Toys R Us is closing its doors after 70 years in business. The iconic toy retailer will shut down or sell almost all 800 stores in the United States, according to the Wall Street Journal and CNN Money. Now, here in Canada, they hope to keep them alive by being bought out. We'll have to wait and see what happens there. I would be surprised if they are actually purchased by anybody. More than likely, they end up going out of business, similar to Toys R Us in the United States. But 33,000 jobs in the United States are at risk. And Harold, it was interesting to note, of course, Donald Trump getting rid of a lot of different people here in the last couple of weeks. Just imagine finding out that you were fired on Twitter, and they don't even have the decency to give you a call beforehand. Pretty unbelievable. But incoming White House economic advisor Larry Kudlow, formerly of Kudlow and Kramer on CNBC, gave a trading recommendation in his first interview after his appointment was announced. He says, buy King Dollar and I would sell gold. Kudlow, recently a critic of the Federal Reserve policy, is a longtime supporter of low taxes and said the permanent cuts for individuals should come under phase 2 of the fiscal overhaul. The dollar was unchanged as a result. But Harold, usually when you hear those things, you go the other way on the trade. When they say buy the dollar, okay, that means buy gold. It does not always seem to be the case.
Exactly. I mean, if anybody knew, they would be filthy rich type of thing. It's his opinion, but the fact is that the dollar isn't doing anything at this point. Dollar is sitting where it is, trading in a very tight range. The only currency that the U.S. dollar seems to be strengthening against at this particular point is the Canadian dollar, which obviously proves at this point here that the Canadian government wants a weaker dollar for export purposes, but it just doesn't coincide with the fact that they were raising interest rates. You don't raise interest rates unless you want a stronger dollar. That's how you fight inflation. And the fact is that we saw, in Canada, a few interest rate hikes. And the fact is that we're seeing them in the United States, but they've got to be manipulating the currency in the U.S. because if we're going to get 4 interest rate hikes in the U.S. this year, that's going to strengthen the dollar. That's how you do it. You raise interest rates. Back in the 80s, when interest rates went all the way up to 22%, it got that way because of raising the price of the dollar. So the fact is that when gold hit $850 back in the early 80s, the dollar was weak, but it was starting to strengthen because interest rates went all the way up to 22%. And when the U.S. dollar got strong again, that's when gold dropped all the way back down to $250. So the fact is that there's a direct correlation between gold and the US dollar. There always has been. And the fact is that what we're seeing right now in the marketplace, because it's literally impossible to raise interest rates and still have your dollar not move. And that's what the US dollar is doing. Don't forget, once Trump got into office, the US dollar rallied strong. It went above par and went to 103. At that point, I felt that the US dollar, if Trump was going to do a great job, US dollar was going to go back up to 110 to 115, which actually would have pushed gold down below the 1,050 level. But that never happened. So the fact is that if the US dollar continues to trade in and around this range, that's why the price of gold is supported above the $1,300 level. And if we do see any type of geopolitical situation, my gut feeling tells me that it's going to be based around Trump. You've got the Stormy Daniels embarrassing situation that's going on at this point, the porn star that is linked to President Trump. On top of that, all the threats that he makes. How about all the people that he's fired since he's been there? I mean, I don't think that there's ever been a president in history that has fired as many people as Donald Trump has. So I just don't see any real stability in the White House at this particular point. In actual fact, the country is up in arms with the shootings and everything that's going on. There's a lot of negativity at this particular point. The only thing that seems to be bullish at this time is the Dow. And the fact is that we know that the Dow marches to the beat of its own drum. It doesn't matter what's happening around the world. It does not affect the Dow on the downside. It would have to be something tremendous in order for the Dow to take a substantial drop. Yes, we saw a 1,600-point drop in one day, but the fact is that with the market at 25,000, that's not an out-of-line correction in the market. The fact is a lot of analysts are talking about the potential of the stock market dropping 50% or 40%. In order for that to happen, it would have to be something similar to what happened back in 2008 with the mortgage crisis, or it would be a major hit on one of the other situations that are present in the market at this particular point. So as far as I'm concerned, it's not a place that I'm comfortable trading at this point. Most Americans cannot even afford to invest in the Dow at this particular point. It's so expensive when you're looking at prices of stocks like Amazon and Google and all that type of thing. It's just, you can see the way that the world is going at this point here. It's primarily because of Amazon that Toys R Us are going out of business. In actual fact, Amazon has put out of business not only Toys R Us, 900 stores that are going to close, but on top of that, they have put other major retailers, clothing retailers, out of business. So the fact is that you're getting these giant corporations that are making all of the money and basically controlling, what's happening in the retail business. And the retail business is not good. I don't see how the malls are going to stay open if all these retailers are closing their stores. So the fact is at this point here, right now, most of the markets are trading within a range. We feel that there's a very good opportunity that gold is going to break out. Is it going to be because of the dollar? I really don't believe that we're going to see a big enough change in the dollar that's really going to affect gold. I think that the major move in gold is going to be because of Trump. I do believe he is going to do something that is going to be so bad and so embarrassing for the country, and either get impeached or thrown out or whatever is going to happen. But that's what I see happening, and that's why I would like to own physical gold at this particular point. The bull market that we were involved in back in 2000 was the greatest bull market in history. Gold went from 250 all the way to 1900. It was an 11-year bull market that was phenomenal. People that participated in that made fortunes. Fact is that I don't know if we'll ever see anything like that again, but that was a run that started in 2000 at $250 and went all the way to 1900. Gold would have gone substantially higher than that if the exchanges didn't get involved and really stop the rally in gold by raising the margin requirements and making it so expensive. If this rally is starting at $1,300 and we do get another really strong bull market in gold, it's possible that gold could go to $4,000 to $5,000. That's where we felt that gold could have gone to prior to 2011 when the market was forced to sell off. So again, you can only play with the market so much. I know that the government is playing with the currency markets, and that's primarily obvious because of the fact that we're raising interest rates in the States, and we're going to raise them 4 times here in 2018, and the dollar is still falling off or trading within a very, very tight range. So again, Randy, at this point here, something's going to break within the very near future. My gut feeling tells me it's going to be because of the White House and Trump, and that's where the next major bull market in gold is really going to come from.
Speak with Harold about his program that he has in place when it comes to investing in hard assets. We're talking about diamonds, gold, silver. Connect with Harold at 1-800-432-1022. 1-800-432-1022. His website is rarecoloreddiamonds.com. rarecoloreddiamonds.com. Get our free weekly newsletter, the companion to the podcast. It has all the information that Harold and I are seeing on a weekly basis. You'll be on the same page we are as you listen to the podcast. All you need to do is get your name on the list. We send it out free of charge via email every week. J.P. Morgan, the co-president, sees a possible 40% correction in equity markets. His name is Daniel Pinto. He warned that equity markets could fall as much as 40% in the next 2 to 3 years. His comments come as investors worry over the effect of central banks raising interest rates and rising inflation. He says it could be a deep correction. And he is the bank's co-president. He was interviewed by Bloomberg. It could be between 20 to 40% depending on the valuation. The benchmark S&P 500 index has gained about 47% since February of 2016. We know there will be a correction at some point, Pinto said. He oversees trading and investment banking at the big bank there, J.P. Morgan. He said the markets are nervous, and if Donald Trump goes beyond what he has already announced on steel tariffs, then investors could react very badly. The prospects of a global trade war has markets on edge as Trump announced last week steel and aluminum tariffs were met with a lot of talk of retaliation in China and in Europe as well. One of the other things that we have in our free weekly newsletter, and this is not a surprise to any Canadians, Pelose, who is the head of the Bank of Canada, will weaken the loonie. That, according to a top fund manager, the Bank of Canada will weaken the currency to support exports as Canada's economy slows. That, according to Peter Kostopoulos, one of the country's top-performing bond fund managers. He said the Canadian dollar will continue to drop against the U.S. dollar, and he says traders paired their expectations that the Bank of Canada will aggressively tighten monetary policy. In fact, Pelose gave a speech this week, and he said he's not ready to take the punch bowl away. And as a result, the dollar is really having one of the worst months that it's had in a long time, and it's one of the worst performing major currencies this year. In fact, when you take a look at it, as of Tuesday morning, it fell a half a cent when he gave his speech, suggesting that the pace of interest rate hikes would become more gradual as the economy expands without triggering inflation. The loonie fell a half a cent. And as a result, we're seeing that the loonie is one of the worst performing currencies in the world this year. It has been hit by a stronger U.S. dollar, lower oil prices, and fears of a trade war. You factor in NAFTA as well, what's going to be happening there. And people, Harold, are very, very concerned about the loonie, and so they should be, I believe.
Now, most Canadians will not notice, in all reality, the weakness in their currency unless they travel. That's the way most people realize that their currency has fallen. Otherwise, it really doesn't affect everybody on a day-to-day basis until you start to factor in the fact that a weak dollar doesn't buy as much, and that's inflationary. So the fact is that a weak Canadian dollar is obviously not good for the economy. The only thing it's good for is the fact that it prices Canadian exports cheaper into the market, and that should bring in more business. But as you mentioned, Randy, with NAFTA up in the air and everything else that Trump seems to be doing, he doesn't seem to care about anybody or anything except himself and trying to make a good name for himself in the U.S., but he's making an awful lot of enemies. And the fact is that, the world is trading partners, and he's basically, hurting those relationships that have been going on for many, many years. So that's why I believe that he is going to do something within the foreseeable near future that's going to be catastrophic to the economy, to the currencies, to the reputation of the United States, and it's going to show up in the marketplace. So again, things at this particular point are not so cut and dry. We're again seeing interest rate rises in the U.S., but the U.S. dollar is not really gaining, and it's not gaining against the Canadian dollar in the sense that the U.S. dollar is strengthening and the Canadian dollar is dropping. The only thing that's happening at this point here is that the U.S. dollar is sitting in a tight range, but the Canadian dollar is falling. So it's not that the U.S. dollar is doing anything amazing. It's just that the Canadian dollar is falling, and that is going to bring in additional business into Canada. In actual fact, it was during that time when the Canadian dollar was so weak that the real estate market really took off again, because you had so many foreign investors that were coming in and buying up all the real estate in Toronto and in Vancouver. But the fact is that now that there's laws in place that heavily tax those type of speculators, I don't think that the weak Canadian dollar this time is going to have the same effect on the real estate market.
Speak with Harold about investing in hard assets, gold, silver, diamonds. 1-800-432-1022. Give him a call, 1-800-432-1022. The call is free. Anything discussed, 100% confidential. Get our free weekly newsletter, the companion to the podcast. You'll see all the stories that we're talking about. You can go through them in minutes or spend hours. It's really up to you. But now more than ever, as Harold is saying, when you have a president that sends out a tweet and the Secretary of State of the United States finds out he's fired, Rex Tillerson, this is a very substantial man. He ran ExxonMobil. That is a very powerful position to be in. He accepted the job, I think, more than likely because he felt that he would be helping his country. He felt, okay, it's my duty. And you hear that a lot with people who have been working with Trump. They're not doing it because of Donald Trump. They're doing it because of their love for their flag and their country. And you could see Rex Tillerson, when he went and spoke after being fired, he was very emotional. And I don't blame him, because what did he do wrong? No one seems to know, but he did get fired with a tweet. And at some point, as Harold's saying, we could wake up one morning and Trump could have crossed the line. You'll be very happy that you have hard assets in your portfolio. 1-800-432-1022, and the website is rarecoloreddiamonds.com. One of the things that we found, and it was right after 9/11 and even the financial crisis, that they wanted to get people buying cars again. So instead of a 3 or 4 year loan, which is standard, they started to go to 5, 6, and 7 year loans, which you never want to do. That is an absolute disaster. Well, that has happened in Canada and the United States as well. And here in Canada, interesting story this week, Canadian longer car loans, mortgage renewals are risks for the banks. They need to keep an eye on, according to Moody's. Delinquency rates remain low, but that could change in an environment with rising interest rates. Rising consumer debt loads aren't a problem for Canadian banks yet, but they soon could be, according to a new report from rating agency Moody's. In a report that was released on Tuesday, the agency warns that the credit quality of Canada's biggest lenders is under threat in part due to longer terms on car loans and more than half of the Canadian mortgages that will see their rates increase this year. So this is a situation we need to keep an eye on, as here in Canada we have a scenario where when they do start raising interest rates, we could see pressure on the Canadian banks. In the United States, and I personally believe this is a major problem, there are some who don't believe it is a problem, that the United States can rack up massive debt and deficits. They're up around $21-22 trillion. They're running deficits of about $500 billion, a half a trillion. Well, the United States posted its biggest budget deficit since 2012. The U.S. recorded a $215 billion budget deficit in February, its biggest in 6 years, as revenue declined. Fiscal income dropped to $156 billion, down 9% from a year earlier, while spending rose 2% to $371 billion. The deficit for the fiscal year that began in October widened to $391 billion, compared with $351 billion the same period a year earlier, according to the Treasury Department in the United States. But here you have a scenario, Harold, where the United States continues to go into debt deeper and deeper, and they are auctioning off, and we have this story. Bond traders have become very leery of U.S. auctions for debt because here you have Donald Trump in the White House. You have a lot of risks going on right now with Trump and the tariffs and obviously the NAFTA agreement. And yet they want, as a bond trader, to be fairly compensated for the risk they're taking on if they're going to be buying that bond. And that's where you could see interest rates start to go up, because bond traders go, no, we're not taking part. You need to have that 10-year note go up higher. I need more of a rate of return if I'm going to take on that risk. And this is another reason why people in the United States should be very concerned, not only with the debt and the deficit, but at some point, Harold, who's going to be buying it all unless they get a proper rate of return?
Exactly. Well, it's not going to be China, and China is the biggest buyer of our bonds. And if we continue with, this attitude that we have towards China, which is negative, and obviously with the steel tariffs and all that, that's something that is that China is not happy about, because obviously China produces inexpensive steel and has always exported it. And now if that's, going to be much more expensive because of the tariffs, they're going to retaliate in some other way. Now, they could basically not only not buy our bonds, but they could sell off the bonds that they already have. And that would create a massive problem, because nobody would be buying our bonds. And that means that our debt situation would be even worse. So the fact is that Donald Trump is spending a fortune. He is spending so much money. He wants to build that ridiculous wall that's going to cost billions of dollars and cause a tremendous amount of problems with Mexico and other countries, even though immigration in the United States is certainly a problem. There's no doubt that the borders are not being watched properly, and bad people are coming into the country. That's something that, again, is a major concern. But building a wall is not something that's overly popular here. And the fact is that Donald Trump wants to spend a fortune, and it would cost a fortune, and it needs to be done. That's the whole thing. But the infrastructure of the roads and the bridges and things like that in the United States are in terrible shape, and they've got to be redone. But the cost is astronomical. So where does that money come from? Again, on one hand, it's got to be done. On the other hand, there's no money to do it, unless you're going to raise taxes, which is an unpopular situation, especially since Trump just lowered taxes. So that's not an option. Or do they start, charging more for tolls and things like that? So bottom line is that the U.S. is in huge debt. They're going to have to continue to raise interest rates. As I said I think Powell said he's going to raise it 4 times this year. And if at a quarter of a percentage point, we're up to almost 3%. Not that that's a huge number, but if you have a large mortgage or a lot of debt, every percentage point that goes up costs you an awful lot of money. And that's where the major problem is going to be, is that if you continue to raise interest rates, it's going to hurt the general public that has a lot of money out there in loans because money was so cheap that people are buying things. When you talk about cars and these 6 and 7 and 8 year car loans, we all know how much a car depreciates as soon as you drive it off the lot. So the fact is that if a bank is going to give out a 6 or 7 year car loan or longer, and that car is depreciated to way below what the loan value is in the 3rd or 4th year, then that's going to be an issue, because if these people start to default, then the banks are going to be in trouble. So again, it's a catch-22. On one hand, they're trying to promote more business and make it more attractive and make the monthly payments cheaper. But then on the other hand, you've got the government that's raising interest rates that are making them more expensive. So it's going to be an issue. There's no doubt that the banks are going to feel the pinch from not only these car loans, but mortgages that are going to go bad because people were speculating in the real estate market in Canada. And that's a no-no. You don't speculate with your most valuable asset, which in most cases is your home, and that's exactly what has been happening.
Well, it's interesting to note, too. I have a young friend, he's in his late 20s, and we went out and had dinner with his girlfriend, and he had to renew his mortgage, and I think he was going to be renewing around, I'll give a ballpark estimate here of around 3.5%. And I said, do you know how low that is? Because I remember as a kid, and Harold remembers well, in the 70s, when you had interest rates at 15 to 20%. And young people today don't realize how good they have it when it comes to interest rates on loans. But you can get yourself into trouble. I saw something on television where this girl went out and bought a brand new car. It turned out, it sounds to me like it was a lemon, which obviously bad break. She had to go and either spend a whole bunch of money to get it fixed, or what they did is they traded that vehicle in on another new vehicle. All said and done, she ended up owing around $55,000 on the 2 vehicles and had to work 2 jobs to get by financially, all because of one bad lemon of a vehicle. And, you just see these scenarios, and it's very upsetting and very disturbing. And 66% of millennials have nothing saved for retirement. Most millennials are not on track when it comes to retirement saving. That's no surprise after paying bills, rent, and making student loan payments. There's often not much left over each month for young people, many of whom enter the workforce at a time of stagnant wages and high unemployment. But a new report shows that things might be getting better. About 66% of people between the ages of 21 and 32 have absolutely nothing saved for retirement. And Harold, I've always learned, and this is from Jim Rohn, listening to Jim Rohn and seeing him in Edmonton a few different times. He's passed away. He was a business speaker, and he always said, pay yourself first. Treat yourself as if you are a bill. And he always said the difference between the rich and the poor is the poor spend the money they have first, and there's nothing left over. The rich, they go ahead and invest first. They invest first and then spend what's left over. And I know that's a philosophy that I've used in my life, and I think it's worked very well. But I would encourage people who are millennials, and everyone has a different way of doing it. There's many different ways of skinning the old proverbial cat. But one way to do it is treat it like a bill every month. You don't see it, you don't miss it. And then, Harold, you're in a position where you do have a little bit of money at some point to hopefully retire.
Well, it would be nice. It's a pipe dream for most people because, again, you got no return on your money in the bank. I mean, there was a time when you used to get 10% on your money or more, and that was livable. You had a $500,000 sitting in the bank. and you're now ready to retire, you're making $50,000 a year. People can adjust their lifestyle to live on that kind of money going into retirement. But that's not possible today because interest rates are at 1%. And at 1% on that same $500,000, instead of making $50,000 a year at 10%, if you had $500,000, you're making $5,000. Who in the world could ever retire on that kind of money? So the fact is that it's much more difficult. And what it actually does is it forces you into other investments that are much more speculative because you need the return. And the stock market is exactly that. It's speculative. Most people that invest in stocks lose their money. Even though the Dow is sitting at 25,000, it's so expensive that people get nervous. And if a stock like Google, which most people can't even afford to buy, it's so expensive at this point. It's just a very, very difficult time. Looking at the millennials, they've got a totally different attitude. Most of them live with their parents. 40% of millennials between 22 and 35 years old still live with their parents. 40% in Miami because it's heavily Spanish. And then there's 40% of these millennials that may live on their own at not a high level, but get supported by their parents. So if that's the direction that this new generation is going to, it's going to be an issue down the road. That's why, in the States, they all wanted Hillary Clinton because, being almost socialistic, she would have had the government paying for all of these and have the wealthy, the people that work and actually make a living and pay taxes, support the people that aren't doing as well. Just isn't a fair situation. So all in all, it's a frightening time. Most people don't know what to do. And the fact is that, even a slight rise in interest rates of 1 or 2% can affect you in a huge way, especially if you've got limited income and heavy outstanding loans. So you got to be very careful at this point here. Don't get enamored with, quick money type of thing. Don't go into markets that are extremely risky like the stock market. My suggestion is to be diversified. If you do own stocks, own something to offset it if the market is going to go against it, like physical gold or diamonds, longer-term investments that are not volatile and as expensive as the stock market. I mean, look at Bitcoin. Bitcoin, most people don't understand cryptocurrencies, but the fact is Bitcoin was the first one to come out. It came out at just a few dollars and traded as high as 20,000. But look where it is right now. If you happen to have jumped on the bandwagon late with Bitcoin and bought it when it was at $10,000, $15,000, $20,000 a coin, now you're down to 8,000. So the fact is that these are all very speculative, extremely risky investments that if you don't know what you're doing, you're going to lose your money. Also, when Bitcoin was at $20,000, it was actually not affordable to most investors. So the fact is that the only people that really could own it were the heavy speculators that had the money to do it and the original people that bought into it because most of Bitcoin was controlled by just a few people. So you're seeing, again, firsthand, if you're following that market, how it can go from nothing to $20,000 and now all the way down to $8,000. So again, when you're going into an investment, you got to think twice and do your homework and make sure you're comfortable with the risk, because anything that's going to pay out a higher rate of return is going to have a subsequent amount of risk, and you have to be able to weigh the risk and reward ratio and make sure that it's the proper investment for you.
And there is a lot of pressure on the cryptocurrencies. Of course, Google has come out and said no ads. Facebook, similar. So there is pressure, but at some point there will be something that comes along and it does it right. We should talk about diamonds as we get towards the end of the program. There was a big diamond that was sold this week. The fifth largest diamond in history, sells for $40 million. And the 910 carat Lesotho Legend was sold in a tender in Antwerp, and that is from Gem Diamonds. The company found the stone, which is about the size of 2 golf balls, at its Letsing mine in the African country this year. Well, it's the most Gem has received for a diamond. Other companies have sold for more. But came across an article late yesterday, and it's in our free weekly newsletter Outstanding article on colored diamonds, rare colored diamonds. Crucial reasons why you should invest in colored diamonds in 2018. And it's an article you must get from Harold. Connect with him, 1-800-432-1022. He'll be happy to send it out to you. Global recognition, portability, long-term growth, value retention, durability, rarity, privacy, and obviously they're just very, very beautiful. And it's something that you can wear that obviously is your wealth. But get that article, Crucial Reasons You Should Consider Investing in Diamonds, Colored Diamonds in 2018. Harold, I don't know what you thought of that article. It was one of the best I've read in quite some time.
And the fact is that colored diamonds are a great investment. They're longer term, though. You don't buy them for a few years and then look to sell them. In most cases, the tremendous wealth that is built up in an asset like a rare colored diamond is over generations. The fact is that a diamond was purchased for X amount of dollars and kept in the family for 20, 30, 40, 50 years. And eventually when that diamond was sold at auction, the prices were astronomical. I know we've talked many, many times about, just one example, but there's hundreds of examples like it. But, the Shirley Temple diamond that her father bought back in 1940 for her for $7,100, sold last year for $25 million. That's what we're talking about. You buy an asset like a rare colored diamond, put it away. You could put it into a beautiful ring or piece of jewelry and enjoy it. Most people put it into a safety deposit box and just keep it, for the kids or the grandkids. I've bought all of my grandchildren diamonds where I have not bought them stocks or anything paper. I have definitely put away gold and diamonds, for my grandchildren. Did that also for my children when they were growing up. So, again, it's an excellent asset to own. Again, it takes, do you remember, it was a few years ago, I think last year actually, in Greece when things really got terrible there and all the banks had shut down and nobody could get money out of the ATMs and things were horrible. People were panicking. But if you owned, a diamond, you could always turn that into cash. You could always get that money, and whether you made money or not, it just got you back into the game. Now you have some money, you can pay bills, you can get back into business, you can do other things with it. There's not too many assets that are like that. We saw in 2008 when the stock markets crumbled from 14,000 to 6,500, so many companies went bankrupt. And so many more would have gone bankrupt if the U.S. government didn't step in, print all that money. We all remember quantitative easing. And basically at that point, you had General Motors going under and Chrysler going under and the major banks going under. And so many companies were in trouble because of that situation. So the fact is a stock can go to zero, but gold or diamonds never, ever will. So, again, it's an important asset to own. It's a longer-term investment, but it's an investment that could make your family an awful lot of money. And under very extreme circumstances, we're in the United States right now where so many people are enamored with and very confused with the White House and with Donald Trump. You've got a lot of people that expatriate, that give up their passports and go to another country to live. I know that's an extreme situation, but there are certain people within the United States that are actually very concerned and don't consider Donald Trump their president and are leaving the country. Now, it's very difficult to leave the country with your cash and with your stocks and physical gold and things like that, but diamonds are portable, transferable wealth, and they can get you started in another life at another time in another country almost easier than any other asset because they're so easy to transport. As long as you own them and own the paper and you're going to stay out of the country, you can take that diamond with you. But if you took more than $5,000 in cash, you're going to have issues at the border type of thing. So again, hard assets are extremely important, especially during times of economic uncertainty. And I would certainly say at this point that we qualify for economic uncertainty at this particular time.
Well, always remember what we've said on the show before. Invest in things governments can't print. Obviously, they print money, print bonds. They cannot print diamonds, gold, silver. They cannot print a car or real estate or art, collectibles. And that has stead many people very well for hundreds of years, having a hard asset in their personal control. And that's why we obviously are advocates for hard assets, gold, silver, diamonds. And you can speak with Harold Siegel and find out more. Go to his website, rarecoloreddiamonds.com. Telephone number 1-800-432-1022. Harold, thank you for your knowledge and another great podcast.
It's my pleasure, Andy. I wish everybody a wonderful weekend and a very profitable day.
Have an outstanding St. Patrick's Day to everyone on Saturday, and next week, Tuesday, is the first day of spring, so enjoy spring. That's it, another edition of the World Financial Report podcast with me, Randy Marshall, and Harold Siegel. We will talk to you next week.